The stock market is panicking today on full-blown concerns of a new pandemic, on the economy weakening, and on Trump's new tech tariffs. Yeah, we'll discuss all of that throughout this video and what in the world is happening to markets. Why this could be a little concerning, specifically referencing bonds that are seeing a massive bid today, and what could be coming next for markets. Stay tuned, and let's get started. So first and foremost, without getting too technical, this new SARS virus, coronavirus, it's different than the coronavirus, but it infects humans just as the COVID-19 virus did. Now, this new bat that was found with the coronavirus, this new one, has a high risk of spillover to humans. Now, it says that this virus is more dangerous than the previous virus. Now, this quote-unquote Batwoman said in their study that this new virus, which they called HKU5-CoV2, carries, quote, a high risk of spillover to humans, either through direct transmission or facilitated by intermediate host. This virus can apparently even infect other mammals like dogs, cats, cows, chickens, things that we frequently come in contact with. Okay. It does go on to say, in their study, they noted that the HKU5-CoV2 was more dangerous than its predecessor virus. So basically, like a new coronavirus is part of the fear that is entering the markets today. Now, ultimately, I don't think we will ever see another lockdown again, unless there was something seriously dramatic, okay? Unless it was like a high mortality rate, something along those lines, in which we don't have any transmission into humans yet. The fear is that that could happen. And then the fear obviously is shutdown and more stimulus and more inflation. And honestly, the implications for the economy and for the stock market broadly are like heavily unknown. Because if we wouldn't go through a lockdown, would we have stimulus? Would everyone just get sick? Would people just die? I mean, there's a lot of unknowns here. And it's the uncertainty that usually hits markets hardest. Yeah. Now, I think the thing that makes me a little nervous, at least in the short term, is the reaction you're seeing in the bond market. Because bonds are reacting to this. Bond yields are moving higher, and they were, based on the economic data. This right here was the bonds reacting to the economic data. This right here was the bonds reacting to what could be a new pandemic. So the bonds are reacting a lot today. Yields are shooting lower on the economic data, on the, what could be new pandemic. And obviously, it's way too soon to know that, and I think we'll know more, from insider sources in China, if this is actually becoming a problem or not, because that's what happened with the first, coronavirus. We started to see people in hazmat suits on the street in China, and people were getting sick, and we really didn't get too many headlines on it at first. So we're not seeing anything like that. But that is affecting the markets today. And until we get new, worsening progression of a potential pandemic, I think markets will be quick to kind of brush this off. But the problem would be if this does, get into something much worse. If you do start to see similarities between, COVID as we know it, and that process, like hazmat suits in China and people getting tested on the streets, things like that, then you're going to dive more into a problematic kind of environment. If people actually do test positive for this, if it does spread into humans, yeah, you're going to be up shit's creek. What's China's response to this, I think, is another question that we don't have. Because even if the US would not, quote unquote, lock down, China did a lot less stimulus the first time around and dealt with COVID a lot harder. Would they lock down again and start sending out stimulus, kind of take a playbook from the US? Does China do nothing? We don't know. And China is a very important global economy. So I think that's part of the fear right now as well. What if China were to slow down? What kind of impacts would that have to the world, and to US markets? Highly, highly, highly uncertain. Now, you can also see this headline here. The Dow tumbles 800 points as market sell-off gains steam. So I do find it interesting that markets are reacting so much to what CNBC says, the state of the U.S. economy, because of the data that we got today. I'll share that with you in just a moment. But also this new, what could be pandemic. Like, markets are reacting to it a lot more than we did like tariff headlines and other, scary headlines recently. This is something that is actually getting some market attention. You can see across the board, it is carnage. Russell 2000 is down almost 3%. NASDAQ's down over 2%. S&P's down almost 2%. And the Dow is down about 2%. The VIX is also up about 20% today. And just throughout the day today, there was no relaxing with the VIX. The VIX just moved higher and continued to move higher throughout the entire day, really. I mean, just look at this as it loads. You ramped up and you continued to ramp up. What looks like into even the close of the day today. Now, if you look at the bond market is where we get a lot of cues. You could see 10-year Treasury yields are down almost 8 basis points. And that's the thing that I think you want to pay attention to right now, because as the bond market reacts, that's big money. I mean, bond market is much larger than the stock market. So again, part of this is weakening economic data, and part of this is a potentially new pandemic. Now, before we get into the big headlines that caused markets to fall today, specifically big tech, let's take a look at the data that came out here. And we had a couple different data sets. Composite PMI came in at 50.4, lower than the estimate of 52.7. Manufacturing PMIs came in at 51.6, pretty much in line with the forecast of 51.5. And global services PMIs came in at 49.7 versus the estimate of 53. So services now going negative for the first time in a long time. There's some concerns about economic growth, I would say, at this point. If services continue to weaken, the economy is not going to be in a great place. And I think that's part of what's going on with the markets today. Existing home sales came in at 4.08 million, coming in lower than the estimate of 4.12 million. Existing home sales month over month came in at negative 4.9% versus estimates of negative 1.7%. Michigan consumer sentiment final numbers came in at 64.7, down from 71.1 in the prior reading. So that's a big drop and about 3 points lower than the estimate. 5-year inflation expectations actually went higher from 3.2% to 3.5%. They were expected to go up to 3.3%, but jumped all the way to 3.5%. So not great. Consumer expectations at 64.0 versus estimates of 67.3. Current conditions came in at 65.7. Last month it was at 74. And that's dropped from 68.7 in just the reading we had, 2 weeks ago. It says 1-year inflation expectations remained the same at 4.3%. This is very much a political survey. Okay, that's it. So when you see inflation expectations rising, it's Democrats that are rising that. Republicans expect almost no inflation. Independents expect around 3% inflation. It's the Democrats that are expecting a lot of inflation from tariffs that are pushing these numbers higher. Now, the Pentagon says that they have hit pause on a plan to carry out mass firings of civilian employees. But this is really the big news today that caused tech to sell off. Quote, Trump eyes tariffs to counter digital taxes hated by big tech companies. Trump to direct USTR to weigh digital tax remedies, people say. And a lot of people suggest that this is actually good news for Apple and, Facebook. But the issue, I guess, would be if, these countries retaliate back. And I point out, Meta and Apple, but really all big tech. Okay. If there's a trade war within even tech, not even just physical things like aluminum and cars, but if this is something that spreads into tech and IP, that would be a bigger problem for, again, big tech, which is a large portion of our markets. Do I think this matters in the grand scope of things? Absolutely not. But days like today, where you have economic data that is weakening, services that are essentially like plummeting in the last 2 months, and inflation expectations that went higher, and the weird consortium of news we had today, add this on top, and yeah, you're going to have a bad day for markets. U.S.-Ukraine mineral talks at a, quote, make or break moment for Ukraine. U.S. and Ukrainian officials negotiated all night and Friday morning in an attempt to conclude a minerals deal and halt the deterioration in relations, a U.S. official and a source with direct knowledge of the issue told Axios. U.S. Treasury Secretary Bessent and China agreed to remain in communication. The U.S. administration believes Kurdish oil sales could help to lower oil prices, offset a drop in Iranian supplies. And the U.S. administration asked Iraq to resume Kurdish oil exports quickly or face sanctions alongside Iran. China's Vice Premier He says China expressed solemn concerns on U.S. tariffs on China. Trump says that we need to double the energy that we have right now. He says companies need more electricity for AI, and companies are coming in. They need electricity. Trump reiterates 25% tariffs on cars coming on April 2nd. Trump says that we're going to have a lot of chip makers coming into the country. Trump says he spoke with Apple's Tim Cook on Thursday, says Apple is shifting plants because of tariffs. Apple will build plants in the US, not Mexico. That is official. Now here on the day today, the CNN Fear and Greed Index is at 43, down from yesterday being at 45. So you are in fear. Market momentum is fear, stock price strength, extreme fear, stock price breadth is neutral, put and call options, extreme greed, market volatility is neutral, safe haven demand in extreme fear, and junk bond demand is neutral. If we take a look at the percent of stocks trading above their 50-day moving average, seeing a further deterioration here, down to 47.2%, down about 2% today. So less than 50% of stocks trading above their 50-day moving average is not a very strong market. So, this is seasonally the worst 2-week period for markets in any given year since 1928. So it's not a shocker or surprise. Markets are moving lower, yesterday and today. But, we're already pretty weak. So how much downside are we going to see at this point? I guess we'll have to see, but I'm not super concerned about that at this point, although there's definitely some red flags we need to be watching for and to see when the Fed pivots, because if the Fed waits too long, then we're going to have an issue. Now, we dropped from the highest level of bearish investors in multiple years down to 40.5% of investors that are bearish. That's still very high. 30.3% of investors that are neutral. That's pretty high. And bullish investors, which is very low, at 29.2%. Again, people are just not, bullish right now. And that's something that from a contrarian standpoint would be seen as positive for markets. So let me know your thoughts about all of this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.